Greetings, Professor. Welcome to Group D's presentation. In this video, all of us have collectively covered how Australian companies are expected to pay a part of their earnings to the Australian government in the form of income tax. Before we dive in, it is crucial for us to understand the fundamentals of taxation. Income tax is a significant revenue generating tax imposed annually by the Australian government on businesses. Now, let's take an example of trying to explain this concept to a 6 year old and an adult. So, it's just like sharing a few of your toys that you play with daily. And in the same way, companies share a few of their earning with the government. However, the toys that the kids may be sharing might not match the ones that they have been playing with that week. And the income reported by the companies may not match the amount they claim to share with the government. Hence, it makes it crucial for us to understand that income tax is an aspect of the corporate landscape reflecting a company's financial activities and income. However, statements often reveal discrepancies between the actual tax payments and the calculated tax expense. Here's how we can differentiate between the two by labeling them as accounting profit and the other one as a taxable profit. Let's take example of Group D coming together and running a business of a cafe where the accounting profit is the net income per financial statement, which can be calculated by just subtracting the expenses from the revenue. And then the taxable profit, on the other hand, is the income which would be subject for us to be taxed on, which can be calculated by making adjustments to the accounting profit based on the tax laws imposed on us currently. And realizing the distinction between accounting and taxable profit is crucial for businesses to accurately represent financial health and fulfill their tax obligations. Now, I'd like for my colleague Ken to discuss the relationship between income tax expense and income tax payable.
Relationship between income tax expense and income tax payable. Income tax expense. The income tax expense recorded in a company's financial statements signifies the estimated tax liability based on accounting profit generated during a specific period, and this expense considers various elements, including tax rates, deductions, and provisions for uncertain tax positions. It aims to reflect the expected tax burden related to reported financial performance. Income tax payable represents the actual amount of tax owed to the government at the end of the accounting period. It can differ from reporting income tax expense due to timing differences or temporary variations in regulations, revenues, and expenses for accounting and tax purposes. And this difference can arise from various treatments of certain expense, the timing of revenue regulations, or changes in tax laws or regulations. For instance, a company may regulates revenue or expense difference for accounting purposes than for tax purposes. This disparity can lead to differences between the estimated tax liability and the actual tax liability to be paid.
A profitable company having no income tax payable is often related to the complex nature of corporate taxation and accounting practices. I will try to explain some reasons why a profitable company might report no income tax payable. First, I would like to talk about credits and incentives. Companies can benefit from tax credits, deductions, or incentives provided by the government. These credits can significantly reduce a company's taxable income. As an example, General Electric in early 2000 had a little income tax payable due to various tax credits and incentives. Case in point, renewable energy credits. and research and development tax credits reduce their overall tax liability. Tax loss carrying forward is another important factor. A profitable company might have carried forward losses from previous years. These losses can be used to offset current profits by reducing income tax. In early 2000, Apple had no income tax payable in certain years. The reason was they have utilized tax losses forwards from previous periods when they incurred losses. Thirdly, timing differences play a crucial role in determining income tax payable. In financial reporting, revenue and expenses are recognized based on accrual accounting principles. Therefore, transactions are recorded when they are incurred, regardless of when the cash is received or paid. If we look at the example, Enron Corporation in late 1990s reported profit with a significant timing differences in recognizing income tax for tax purposes. They exploited loopholes and different deferred income, leading to a delay in tax payments. Finally, we need to get a brief idea about deferred tax liability and assets, which represents future tax obligations and future tax benefits. Some profits may be recognized for accounting purposes but not for tax purposes due to differences in accounting and tax regulations. Enron Company, which we discussed earlier, had deferred tax liability due to accelerated depreciation method used for tax purposes by creating a future tax burden. Except for the described reasons, we can summarize following reasons that have significant contribution to this issue, which are tax planning strategies, accelerated depreciation, and international operations. Simply and concisely, a profitable company might not have income tax payable due to a combination of timing differences, deferred tax consideration, and utilization of credits and incentives, and strategic use of tax losses carry forward. So next, it's important to recognize how tax laws lead to the recognition of tax related to assets in the financial statement.
Losses for tax purposes trigger the recognition of tax-related assets in financial statements. Deferred tax accounting is the key principle behind this recognition. Tax attributes and future tax benefits. Tax attributes like tax loss or that that temporal differences are leveraged to offset future taxable income. Recognition of a deferred tax asset signifies potential future tax benefits, matching principle and recognition timing. Line with the matching principle, recognizing tax benefits corresponds to when the company expects to realize them. The tax benefits associated with the loss are anticipated anticipated in future periods when the company generates taxable income. For example, a company incurs a tax loss in 1 year and carries it forward of offset tax income in profitable years, reducing tax payable impact of tax rate changes. Changes in tax rate affect deferred tax asset and liabilities. Deferred tax liability and increase deferred tax asset. Conversely, a higher rate may have the opposite effect. Financial statement adjust, adjustment in financial statement reflecting impact of new tax rates on future tax obligation and benefits, designed with the community to provide reliable and relevant financial information to stakeholders. In summary, the recognition of the deferred tax asset ensures accurate representation of expected tax benefits associated with tax losses, contributing to comprehensive financial reporting.
Hey, it's me Sangeeta and I'm gonna talk about What actions should be taken when a tax rate changes? Assess to relevate deferred tax assets and liabilities in response tax rate changes. Reassessment of deferred tax rate assets and liabilities. Companies had to reassess the carrying amount of their deferred tax assets and liabilities. And next point, financial statement. Company made adjustment to their financial statement to reflect the new tax rate. At third point, communication with stakeholders. Companies communicate the impact of tax rate change to stakeholders, including shareholders and regulatory bodies. And at last, strategic tax planning. Companies engage to strategic tax plan to optimize their tax position under the revised rate. Why? Ensure agreement with accurate financial reporting. Reflect the impact of new tax rates on future tax obligation and benefits. For example, in DCAP face the reduced tax rate, the business should consider potential decrease to deferred tax liabilities and increase in deferred tax assets. Adjust financial statement accordingly for transparency and compliance. In conclusion, it is very important to timely address tax changes so as to be compliant and carry out smooth running of the organization. Re-evaluation of assets and liability helps to find a better picture of company. Financial adjustment need to be made to be accurate and efficient. Effective communication is very crucial to maintain trust with the stakeholders. And at last, also strategic tax planning should not be ignored to maximize benefits. Thank you so much.